Well, let's talk about markets with our Alpha Manager of the day, Aditya Sood, is Portfolio Manager at InCred PMS. Aditya, welcome to, good to have you back. Thanks very much. Welcome to the show. I see that in the recent changes you've made to your portfolio, what intellect design? Can you talk to us about that? Because numbers were disappointing. The stock did see a pretty large reaction on the back of these earnings. What was the rationale and why do you like it?
Sure. So thanks for having me, Prashant. Actually, if you look at intellect design arena, it has got a very unique positioning, because it is earlier competing with companies like Fenestra. Now it is competing with companies like Temenos, which is a global champion on the product side in the BFSI vertical. Now, first of all, the company has a very large TAM. The TAM is closer to $30-odd billion. The stock has, ever since the demerger happened, the stock went on to becoming a 10x stock. And now what we see is that, the correction has been very, very sharp in the stock. The stock has fallen by close to 60-odd%. Obviously, the market is a bit disappointed by two factors here. One is the growth factor, because initially, the company was guiding for a 25% odd growth, which has been downgraded to 20-odd%. And secondly, the margins. Now, we do believe that as they migrate from more towards cloud and being SaaS revenues continue to inch up for the company, they are close to 23-odd% today. So what we believe is that, over a 3-year basis, SaaS can be easily close to 40%. And when there is a migration to the cloud, obviously it is a pay-per-use sort of a model. So we are buying the stock in a weakness. We believe that the valuations are very, very undemanding at 15 times 1 year forward. So this is purely positioned as a unique play on the cloud side. We were looking at a lot of companies. Unfortunately, SaaS plays in India are very, very expensive to own, or the analytics plays are very, very expensive to own. And that is why we are buying into intellect on a weakness.
Okay, Aditya, afternoon. What about Bharti Airtel? The company seems to be firing on all cylinders when it comes to the numbers. India Mobile, even the enterprise business, the homes business is doing pretty well as well. But that's a stock where you are cutting your positions. Can you tell us why?
Yeah, sure. So essentially, Bharti, we have been, 2.5 years. It has been a 2.5-year-old position for us on the AF side. What we find today is that, we would ideally like to avoid companies which have got dollar debt. So that is one of the reasons. Secondly, valuation arbitrage was there. We bought Bharti when it was trading when the India business was possibly trading at 6 times the EV by EBITDA. Today, what we see is that, that valuation catch-up is behind us. Even though Bharti has done a phenomenal job in terms of the ARPU inching up recently, but we do believe that 5G is not going to be accretive as far as ARPU is concerned, because we are in the launch phase and we already know what is the pricing been for both Jio and Bharti. So that is the reason of booking some profit in Bharti. It is as simple as that.
Okay, hi Aditya. So you're booking some profit in Bharti, and you have a contra call on IT. And part of that includes intellect design, as you just mentioned. So, our viewers should just take note of that. But, Aditya, everyone's very, very bullish on the auto theme, in particular the CV theme. And you have found another way to play it, Forgings. That one, in fact, has done pretty well in the last, say, 18 months or so. But the big re-rating will come when the multiple gets re-rated. They have a lot of capacity as well. Tell us, what's the rationale out there?
So, Nigel, as you clearly pointed out, autos are cyclical plays. Within that, obviously this company is predominantly focused on commercial vehicles, more so on the heavy commercial vehicle side. Now, one of the things that we see here is that, India has got a clear-cut advantage in terms of forging, because we have got, captive steel mills in India. And second thing is that, power and freight is a very, very large component of cost for a company which is doing forging. Now, what we find interesting about Forging is that, this is obviously they are gaining market share with both Tata Motors and Ashok Leyland in the domestic market. And obviously there is a global play here as well. So we believe that over a period of time, this Euro Plus One is going to be very, very beneficial for Indian forging companies. And clearly that gets reflected in Bharat Forge. There are 3 companies which are listed, RK, MM Forging and Bharat Forge. So we prefer MM Forging because essentially there is a play on more machined components. Machining is a 500 basis point higher gross margin business. So we expect return on capital as well as margins to improve going forward. The valuations are very undemanding at this point in time. Again, the stock has gone through a bit of a correction. If you look at, last 3 months or so. So we are buying into it from a reasonable valuation perspective.
2 more changes. One is you bought Equitas and you've sold IDFC. On IDFC, I mean, has the full kind of structure collapse, etc., everything played out to your mind? So let's start there.
Sure. So essentially, again, it is an old stock for us. Our buying price was, we were playing the holdco discount. So our belief is that, the similar sort of holdco discount is there in Equitas Holdings, which is there. The Equitas merger is around the corner. We believe that there is a 20 to 25% holdco discount, which is clearly unwarranted. Secondly, we have been using this filter of on the small banks of 1.5% ROA, and Equitas is now reporting 1.6% ROA. They just reported numbers yesterday. So what we find here is that, it is a very well managed franchise, both on the asset and the liability side. Essentially, they've done a phenomenal job in terms of liability, in terms of having the CASA that they have. So we believe that there is a similar sort of a valuation arbitrage opportunity, and hence we didn't want to, increase our weight on overall weight on financials, and that is the reason we made a switch from IDFC to Equitas.
Can you talk a bit about this contra bet that you're taking on IT? Is this just a tactical call, and which stocks in the IT pack are looking most attractive to you?
Sure. So one is that we do believe that at this juncture, we are heading into a macro environment wherein demand is not going to fall off the cliff. Second thing is that, if you look at Indian IT story, in every cycle, there is a temporary blip, and over a period of time, we realize that Indian companies typically tend to gain market share. So that is point number 1. Within IT, we are very, very constructive on engineering, research, and design as a play. So if you look at our large cap companies, wherein we have invested, which is a combination of a company like HCL Tech, they have a majority of their revenues within the large cap IT companies coming from engineering, research, and design. So that is one place we are very, very constructive on. Secondly, Intellect Design Arena, which is a unique company on the product side. We do believe that demand is not going to fall off the cliff. Thirdly, the valuations are very, very attractive in our view. You can find IT companies anywhere between 12 to 20 times 1 year forward earnings. Multiples have clearly collapsed. We don't see a scenario wherein multiple compression can happen in these companies. Obviously, growth will slow down. But our view is that, structurally from a 3 to 5 year perspective, IT companies will do reasonably well.
Okay, all right. Just hold on for a minute. Kajaria Ceramics, they have come out with that set of numbers, and actually the numbers are looking a little bit disappointing. I'm just having a first look out there. On the top line, there's a growth of close to around 10%. There was input cost pressure, which we are aware of, but the margins have got compressed to around 12% odd. So sharp compression is what you've seen both on a sequential basis as well as on a year-on-year basis. But Aditya, before we let you go, the big theme and the big consensus play has been banks. Now, you believe it's time to look at some of those smaller banks? If yes, which ones do you believe?
Sure. So we believe that, there are smaller banks like CSB or Equitas for that matter, wherein we are using a 1.5% ROA filter. The valuation catch up for most of the bigger banks has already happened. We have got Axis Bank in the portfolio. We believe that, it is still more reasonably priced amongst the large cap banks. But our view is that, there is a big catch up, which is going to happen after a long time. I am seeing small cap banks rallying, be it Karnataka, be it J&K. So our clear-cut belief at this point in time is that, there is a arbitrage here because you have got well-managed banks which have done a phenomenal job, be it COVID or no COVID. If you look at, Catholic Syrian Bank, for example, it is an excellent franchise. They are closer to 1.8% ROA. More importantly, we are getting into a zone wherein obviously growth is going to accelerate. Majority of the asset quality concerns are behind us. So we do believe that it is a very constructive environment for small cap banks versus large cap banks at this juncture.
It's been good speaking to you, Aditya. Thanks so much for stopping by. We like the contra call that you put out on IT. You believe that some of these smaller banks should be given a look at. An interesting way of playing the CV space via forgings. Thanks so much for joining in and sharing, the way you'll have to rejig your portfolio as well as your view on the markets. Well, for the time being, though, we'll slip into a short break. But as always, on the other side, Nimesh will be waiting for us. He'll be telling us about what's going on in the dealing rooms. We'll also get our technical experts who'll be back with us to give us buy and sell trades for tomorrow.